So I uploaded the videos, I'm going to upload these too. Okay. You've already registered for the GARP and Seeking Alpha, so you should be receiving the articles. And the morning breakfast is probably one of the best. There's updates in there on interest rates and the Fed and stock market. The stock market was down 400 points. I don't know what it's doing today, but it was down 400 points in the 10-year. Treasury yield spiked on Friday. And hopefully Hillary will come back from her pneumonia. That would have a major impact on the markets and politics if something was to happen to her at this late stage. I'm not going to go through the assets today, and probably not on Thursday, because I want to finish off the rest of the lectures. Okay. We did go through the memo formats. We went through the derivative trades, the two sets for the forecasting the prices up and forecasting the prices down. We did go through technical analysis. We went through derivatives, introduction to derivatives. And then today what we're going to do is we are going to go through financial product innovation and engineering. And we are also going to talk about modern portfolio theory. The book does not introduce the concept of financial products and processes as design products, just like any other design process, and doesn't really talk about the marketing and the production associated with financial products and services at all. Okay, and doesn't really talk, I think, do a very well job in really discussing modern portfolio theory. They do make you calculate the portfolio standard deviation. They don't really put it into a modern portfolio theory MPT context, which you really need to understand. Okay, and then what we'll do is when we come back on Thursday, we'll go through the yield curves and the yield curve dynamics, the shapes of the yield curve theory, because all risk-free rates are priced off of the yield curve. And all the models that you use in class start with a risk-free rate, which is priced off the yield curve. There's no yield curve discussion really in the book. You would get that in your macroeconomics, but not in a finance context. It's in an economic context, which is different. We will also look at the dynamic yield curve, and I will show you how the yield curve directly impacts the value of stocks, bonds, and real estate, and other financial assets too. So we really need to have a core fundamental understanding of monetary policy and yield curves. And then I will also take you through the intrinsic evaluation process of the multiple models that we will be using during the course as an introduction. And then we will then move into the laboratory section. We'll break up in teams, we'll work on problems. I'll go through some of the PowerPoints next week and wrap up the first third of the course. Then we will come back. After that, we will go through a more intense investment analysis process. We will also be doing some valuations on some stocks, so if you have any stocks you want to value to use as a lab in the class, bring them, we can talk about them, do them in that part of the class. And then during the second third, I will also be introducing financial integration, which is basically an integration of the macroeconomics and the financial economics, the investment analyses and decision-making process, and I will end with a investment decision-making matrix that I designed that should clarify how you make investment decisions going through multiple iterations to get to either accepting or rejecting the project. And I'll go through a little bit of that today also. Does anybody have any confusion in regards to the memo? Do you have good examples of the memos? Would you like another example of a good memo? Just raise your hand. Say yes or no. Actually, that one's done. That one's done. Actually, I just saw something after the home. Isn't that interesting how please notice that in most of these, the graphics, the graphs are symmetrical to each other, and the data and analysis within the So again, these are the final memos that were produced and then published and approved at the end of the semester. Okay. And if you have an appointment set up with me, make sure you bring your memos so that I can take a look at them and start giving you feedback on them. Oh, you're going to get a license. That looks amazing. Calvin did a nice job.
Thank you.
Calvin did a nice job. And look how nice the grass is.
Thank you.
And then I would try to replicate, again, the memos exactly by format. Okay. You don't need to print them out in color until the very, very last class. I'm trying to give you the perfect ones. And all of your memos should look exactly the same in regards to formatting. And I mean, exactly. Okay, so try to replicate these. Did you need one? I will be, it's a 2-for-1 section. I will be using your memos to distribute to the students next semester. And then I do, if you want to come see me during my office hours, I've sent it around. I brought the solutions to the exams, solutions to the homeworks, and we're happy to go over them with you, even though we'll be going over other ones. All right, so unless there's any other questions or comments, I'm going to get started. Okay. So the first thing I'm going to do is we're going to do 2 lectures, the financial innovation and engineering, and then the modern curriculum. And I should be able to get through them by the end of the class. And again, even though these are not in the book, I will be testing you on these. And you're going to want to bring maybe a couple blue books for the exam sessions. I'll try to limit them to a few questions along the lectures, and I'll go over them before on what they are. And then you can always review the videos and review your notes before you come in. And then you're going to be doing like supply-demand analysis and the fishing frontier and stuff like that. Okay. So I find some of the questions in the book, they're really technical for the homeworks and the exams, but we need to be thinking a little bit more strategically in our thinking. So the reason why I came up with this section of the class is because I realized that developing financial processes and products were no different than developing physical processes and products. It's the exact same thing, okay? But you never get an application of financial processes and products in any class unless you take an executive program. Either the class is designated to it or it's an executive program at Stanford, Cal, or something like that. So I'm going to spend some time on this because I think it's extremely important. The starting point is, how do financial products and processes actually develop? Why do companies innovate? Well, usually there's market pressures or regulatory pressures that causes the firms to basically develop and innovate because the market is demanding those products and services. And the company usually has to reorg due to those external market pressures and regulatory pressures. They got to reorg to be able to deliver the products and services and meet the needs of the marketplace. So this is all a combination of your ops, your management, and marketing classes, all applied to the finance. All applied to finance. So the first is going to be environmental change. And I'm going to abbreviate because it will take me forever to write out a lot of this stuff. So if you get confused in any of the nomenclature, stop me and I'll clarify what I'm talking about. And you probably want to write notes or something, or engage in the process, because this will be on the exam. Okay? So environmental change, and you'll remember this stuff too if you take notes. Okay, my goal is always to have 20 pages of notes when I walk out of my class, when I'm taking classes. So the first thing is environmental change. You've got to constantly be scanning the marketplace. Okay, looking for shifts in the marketplace or due to regulatory responses. The people who are looking at the computers, are you taking notes or what are you doing? Are you? Okay. I just want to make sure. So what happens is as the environment changes, the market changes, and the organizational structure is under pressure to change because the products and services that they're delivering into the marketplace are basically a mismatch. Okay? So they're getting massive amounts of pressure to change and develop products and services. And one of the major changes that has occurred, that has put pressure on financial institutions, was one, the financial crisis, and the regulatory response under Dodd-Frank. Now, obviously, Sarbanes-Oxley, with the demise of Enron and Arthur Andersen, also created a regulatory response, which changed the way organizations actually do accounting and auditing. And also Dodd-Frank has changed the organizational structures of these large financial institutions and has changed not only the organizational design, but also the marketing mix of their products and services due to the regulatory response. Because a lot of these financial institutions were responsible for the financial crisis and the pending recession and mild depression and depressions in other countries. So Dodd-Frank was major. And actually, if you look at the organizational structures of the top 5 banks, JP Morgan, Wells Fargo, B of A, Chase, Goldman Sachs, they've restructured their firms. They do not have proprietary trading units anymore. They do not have speculation going on in their firms. They're now not, they don't have proprietary trading units. They're now commercial banks, not investment banks. So they basically changed what they've done, and they've gone from trading revenues to basically investment management revenues and lending, particularly in real estate, in business, in personal lending. So they've changed their organizational structures and their product and process and delivery systems. To adopt to organizational change or environmental change, the first is you have to look at the industrial psychology. Not only the industrial psychology of the industry, but the industrial psychology of the firm. And then you have to drill in to the individual group psychologies and the individual psychologies associated with those divisions. And a lot of the traders that were heading up the divisions are now gone, and they now work at hedge funds. And they've replaced those traders with investment managers and private bankers, okay, within these corporations, within these financial institutions. And you have to understand, too, that the top 5 banks are highly competitive, and they control 50% of the assets in the United States. It's an oligopoly, so it's a different industrial structure than it was before the crisis. It actually, the crisis and the post-crisis actually consolidated power within the top 5 banks. The next is organizational structure. So you have to change the organizational structure due to the change in the environment. And you're going to have to optimize the organizational structure by divisional line or product line to be able to match the needs of the marketplace, or due to regulatory compliance. So you're going to have organizational and structural change in the organization. Or you have cultural leadership. Culture leadership. And this is actually paid out recently with Wells Fargo. Wells Fargo basically did criminal acts. They were opening up accounts and credit cards for customers in their customer base without them even knowing. And the CEO didn't even know about it. And they fired 5,500 people in the process as retribution for the criminality. Although the CEO said that he didn't know about it. Although, and Elizabeth Warren said you didn't know about it. No, we're too big of an organization and there's a lot of stuff that goes on that we really don't know about it. So what you're doing is you're admitting that you're too big. And basically you should be broken up. Because if you're too big and the stuff is going on, then you can't manage your organization. So there's got to be cultural and leadership changes at the management level. Duty changes in the marketplace and regulation. You have to have clearly defined modified strategy, tactics, operational policies, and you got to plan. And you got to have plans at all levels to be able to execute, but also to be able to understand what it is that you have to do strategically to the firm to move it to align to the marketplace or regulatory pressures and requirements. You also have to be constantly doing competitive market analysis. Because again, the top 5 financial institutions are extremely competitive against each other, constantly developing new processes and products to grow revenue, and trying to steal clients and market share from their competition. So constantly looking at the marketplace, conducting the market analysis, either creating new products or stealing market share. These firms constantly process and product innovation, constantly try to invent new products and processes to grow their revenues. Constantly looking at the marketplace, constantly getting feedback on their products, constantly getting feedback on their brands, constantly looking to streamline processes to increase productivity, to increase earnings per share or net operating income, constantly looking to introduce new products to grow the revenue stream, and constantly looking in the future to maximize the share price at the end of the day. So you're looking at constant and continuous product development. And I'll go through the product development process and how do you design product and deliver it to the marketplace instantaneously to maximize the share, maximize revenues. You need to also implement enterprise planning or ERP systems. So that you're efficiently allocating the resources across the organization to maximize productivity or sales. So you got to understand all the flows within the departments, constantly looking to streamline them to make your processes and your product flows, your flows more efficient. And that will allow you to be able to respond to the market a lot quicker too. You have to be able to recognize client and customer needs and wants. You got to figure out what they want. During the financial crisis and after the financial crisis, customers were saying we can't handle market volatility. I lost, 40, 50% on my stock portfolio. I was getting ready to retire. I can't retire now because I don't have enough assets in the portfolio. I actually had to sell off some of the assets. I'm basically not going to have enough income coming in during retirement, and I'm going to spend through my money, and I'm going to be poor. So I need to be able to invest in products that are going to guarantee a payout of income for the rest of my life and my wife's life. I never want to run out of money. So New York Life invented the guaranteed future income annuity to meet those needs. Also, the market was basically saying I can't handle volatility, I can't handle the loss in my equity portfolio. Can you invent a product where I can invest in equity portfolios, but also provide me with portfolio insurance so that if the value of the portfolio declines, you will compensate me for the value decline, so I will basically retain and preserve the principal that I put in to the annuity. They invented that too. So basically by listening to the clients, they basically took them a year to develop that product. Okay, so it took them a year to respond to the product, which is a fairly short period of time. But by the time they introduced the fixed income annuity, the guaranteed, they controlled 50% of the market. Now they control 40 because competition has come in. But again, at one time they controlled 50% of the market for that product. You have to understand financial product design. How do you design the product to basically do what it's supposed to do and meet the needs of the client, but also have a sponsoring institution that has the credibility, the reputation, and the brand to back the product, so that you're not distributing defective product or product that's going to fail in the marketplace. The product design, development, or R&D. So constant allocations of retained earnings internal to the firm to be able to plow back into the R&D process to design and develop new products to be able to bring to the marketplace to meet the needs of the clients. The product design, to meet the needs, has to really focus on the product attributes. What is the value that the product brings to me as a family or a person or a corporation or senior level executive? And is that value and the product attributes meeting the needs of the client? What is the problem that the product solves? Well, the variable annuity with the guaranteed slapped on it with the portfolio insurance basically mitigates market volatility. The guaranteed future income annuity basically provides cash flows to the principal and the family forever, for the rest of their life, so that they don't spend through their money, and they can maintain a standard of living, and which they're accustomed to. So lifestyle, income, market risk, guarantees, time. I need the product to be able to execute in my favor for the rest of my life, or maybe my family's life, my grandkids or my great-great-grandkids. And then what's the quality? What's the quality of the product that I'm buying? Yes, I'm willing to pay higher fees to get good service, pay higher fees because the product's going to perform over the long run. I'm willing to pay higher fees for a higher quality product. Branded, backed by a solid balance sheet, and with physical product attributes that I know are going to be executed on, and the sales team and the company is going to back that product going forward. Did you have a question?
No, I just asked. I couldn't read something, but...
Oh, it's guarantees, and market risk, and time, and quality of the product. You got to have the operations in place to be able to produce the product and distribute it. So product production and distribution. Do you have smart people that are developing cutting-edge products? And can you distribute those products through your distribution network to be able to scale and distribute the products as fast as possible to start capturing the revenue as soon as possible? So you have to have quick product introduction and distribution. Schwab, Goldman, JP, TD, all these firms, particularly Schwab, when I was working in Schwab, Schwab was like a master marketeer in mutual funds. They could basically introduce a mutual fund. They introduced an equity fund, a new fund, and they basically sent out the marketing and the distribution materials to the Registered Investment Advisory Network. And within 48 hours, they were able to bring in $5 billion in assets under management in 24 hours from the introduction. So they had the distribution network, they had the product attributes, it was already branded, and it basically, through their network of not only their own advisors, but also outside advisors that use their platform to run their business, they were able to distribute the product out and get $5 billion under management in 24 hours. That's pretty effective, not only product design, but also product distribution. Okay, and it's the same for Apple and other companies like that. You gotta be able to understand your marketing channels. What are the channels that are going to be distributed through the products, and what's the mix? How much goes to in-house advisors, how much goes to outside advisors, how much are we going to use advertising, email campaigns, social media campaigns, what's our marketing and distribution mix? What's the optimal mix to be able to maximize the revenue from the sale of these products as they're being introduced within the early adoption phase, and I'll go through adoption life cycles in a minute. You also have to understand the production in your supply chains. And what's your dependencies? What are the constraints and the bottlenecks within the distribution channels to be able to push the product out or the services out? And then how do you manage your supply chain so that if any one of your suppliers goes down, how much of the sales and distribution is taken out of commission? And how long does it take to get another supplier in to basically replace the distribution or the supply augmentation? You have to understand your distribution networks. What are the networks? If the product goes out and the services go out to one overlaying distribution network and then it's distributed to everybody else under that network, how many networks are there, and how many companies and platforms and individuals does it get sent out to? So you have to understand the distribution networks. Sales and sales cycle. Do you understand how to sell? You're going to be selling, okay? You may be an analyst. At some point in time, you're going to move up through the corporation. You're going to be a managing director. You may become CEO. You may become the managing director of business development, marketing, and sales. But you started off in finance and analysis. You may move the other direction too. You're going to be selling to your coworkers. You're going to be selling to your supervisors. You're going to be selling to the clients some kind of service, some kind of brand, some kind of product, and the product may even be you. So you have to understand the sales and the sales cycle. And one of the biggest criticisms that I've got about students is they don't understand the sales cycle. Okay? They really don't understand the sales cycle. They aren't taught good saleswomanship or salesmanship. They're not getting that in the business degree, along with the memos and the pitch books. Okay? So understanding the sales cycle is really the motivation of this lecture, originally. So I'll get into a little bit more on that. So business development. Marketing and sales. The first step in the marketing process is you have to segment the market and identify your markets. So the first is marketing. And market segments. You have to segment the market. You have to segment it by age, by location, by culture, by race, by anything you can, socioeconomics, sociodemographics, to segment the markets. And then once you segment the markets and you understand how the markets are segmented, then you are going to target markets. You're going to target the markets based on psychographics, demographics, sociodemographics, economics, maybe industry, maybe size of firm, or even leadership attributes, leaders who are actually running these companies. You can target. Once you've targeted them, you have to put together effective advertising campaigns. Specific language, cognitive imagery, Ask Chuck. Ask Chuck is one of the biggest, most successful marketing campaigns for Charles Schwab ever. Ask Chuck was a big deal. Snappy, everybody loved it. And then you got to figure out, of these advertising campaigns targeted to your target markets based on segmentation, you got to come up with the optimal mix to get your return on advertising dollars, your ROE on your advertising dollars. Because advertising campaigns and marketing campaigns are extremely expensive. And you got to be able to calculate the ROE, or the net present value, or the internal rate of return, or the break even on that advertising, or that marketing campaign. So you got to be able to run all that PV, MPV, IRR, break even analysis that you're learning in this class. So it's all applied to the marketing side, and advertising side too, but you got to optimize the mix to get the maximum impact and maximum revenue generation from the product and service. Is it social media? Is it print media? Is it television? Is it radio? What is it? What's your mix? That's the most effective for these market segments of these target markets. Obviously, print is probably going to be more effective for older demographics, where social media is going to be more effective for younger demographics. You have to be able to prospect clients from these segments. You have to identify them, you have to reach out to them, you got to motivate them, you got to catch their interest, you got to activate either some fear or greed that is motivating them, you got to get in front of them, you got to call them, get in front of them, meet with them, you got to meet with them, you got to talk to them, to basically find out what their needs are, put together the solution, present it to them in person again, and then lay out the execution plan and execute on it to be able to convert them and convert to the revenue streams.
In terms of market segmentation, would prospective clients be individuals?
Could be companies, could be groups of individuals, could be organizations, could be members within the organizations, could be family heads,
Okay,
could be corporate heads, could be individuals.
okay,
And there's gonna be different efforts, right, associated with who it is that you're targeting, the certain messaging. That needs to be taken into consideration for them to be able to respond to you. And then hopefully you have a brand, and then, because you're gonna have objections, and hopefully the product and the strategy will overcome some of those objections, and then they're gonna have to overcome the objections with you, okay? Because you don't have a reputation or a relationship with them. So the relationship building is probably the most important, okay? When you get down the funnel.
I was gonna ask what ROE stood for.
Return on equity. Could be return on assets, but return on equity. So I'm putting up money to develop this marketing and advertising campaign. It's gonna cost me $5 million. And if it takes me 5 years to break even, I'm not gonna do it, okay? If it takes me 3 years, I'm probably not gonna do it. If it's gonna take me 3 to 6 months, I'm gonna do it, okay? So when do I reach the break even? How soon can I reach break even? And what's my return on invested dollars? Okay? So you're gonna be measured on those metrics. What's my internal rate of return on my invested dollars for the advertising and the marketing campaign? What's my return on invested dollars for the development of these new products? And if I can get high return well above my cost, then we're gonna do it. Okay? It's gonna be worth it for us to do it. And I'll talk about execution in a minute, because you gotta be able to, once you go through all the design phase, then you're gonna have to execute. And if you screw up the execution, you're not gonna make the money, and you have a failed project on your hands. So you gotta find the clients, you gotta prospect for the clients, you gotta convert. What's your conversion rate? I reached out to 5,000 people, I got 500 responses. I actually met with 50 people and I closed on 5. Okay, what's your conversion rate? How fast can you convert, and can you shrink the conversion cycle, which will increase the revenue streams, okay? And that's gonna be process, and it's gonna be, not gonna be product, it's gonna be process. That's gonna do it. What is your process that's gonna allow you to do that? 5 is gonna be the sales cycle. Can I create velocity in the sales cycle? Can I speed up the transaction cycle? Well, if I can speed up the transaction cycle through messaging and communications and process and flows, where I can streamline my flows, I can get more transactions, I can get more assets under management, and I can sell more product. Exchange traded funds, mutual funds, insurance, annuities, whatever it is. So the conversion, so velocity is important. And then also scale. I can sell $1 million life insurance policy on an individual, or I can do $100 million or $1 billion on a group of executives at a corporation. I'm gonna make more money if I do a $100 million life insurance key person sale than $1 million life insurance individual. So as you start to advance in your careers, you go from basically individual task orientation to basically group management, sales management, strategy, and execution. So you're overseeing the process now, and you're doing larger transactions. Customer, client, service. The goal is to lock those clients in. Once you got the client, you basically have a recurring revenue stream. You got them locked in. You're gonna be making asset management fees every quarter. It's gonna come in based on the assets you have under management. life insurance, the annuity products. The annuity products, you'll get a big check at the first when you sign them up. And the life insurance every year when they renew, you're gonna get basically a trailer, you're gonna get a commission trail. Okay? So once you got them locked in, you can build a recurring revenue stream, which is the name of the game in that business. Also, if you do a good job at the customer and client level, you'll be able to build a referral network. Clients will basically refer you, your company, the products to other individuals, either word of mouth, through the phone, through their social networks. Now what you're doing is you're getting prospects that are coming to you now because you basically build a brand and a reputation to be able to execute on whatever the problem is that you're trying to solve. I was referred to John, Martha. Martha, would you do me a favor? I know you want to refer me to John. Would you call John, email John, maybe post something on Facebook? Will you reach out to him, see if it's okay for me to be able to call him? And would you give me a referral saying that I'm going to call him? And then that way when I call him, it's not out of the blue. I got to overcome all the objections. I can now start the relationship building process and to be able to move towards figuring out what the problem is and then solving the problem and then executing on it. So customer service is extremely important. And then customer relationship management. Making sure that you're using the latest technology to be able to capture your relationships and your conversations with time toggles and other things, because you gotta be able to know what you're doing and who your clients are, and what you said to them the last time you talked to them, and what you need to talk to them about when you talk to them next. Okay? This is part of the whole sales cycle process that needs to be taken into consideration. And then this all flows back in a large feedback loop that continues the cycle, the feedback cycle, to create velocity at the enterprise level. So you gotta be able to do it over and over again. Did you get pictures of this or notes? Okay. So the next is really how senior executives in these financial institutions and these corporations think. And they were all trained in business, and a lot of them went to the top schools to get their MBAs, and they totally understand this. But I think it's important to be able to formalize this and lay this out. So the next is really to analyze really the technology cycle. Because obviously with the introduction of handhelds and tablets and other technologies has accelerated the adoption cycle for these products and services. So do you understand technology cycles? And product adoption cycles. So the technology is going to be the enabling technology, and the products are going to have to go through some kind of product adoption cycle for you to be able to figure out what the revenue curve is going to be on this product or process, so that you can then discount back the cash flows based on the projections to figure out if your net present value is positive, or your internal rate of return is greater than the cost of the capital that you use to develop these things. So you're going to be doing that at the industry and the company level to be able to project the revenue streams or the cash flow streams. And I've been asked to do this a couple times, especially when I was trying to sell off my company at one point in time. We were trying to project what the revenue paths would be based on this analysis, and then conduct the financial analysis underneath it. So the first is the S-curves. You might have already been exposed to this within your operations research course. and again, this is applied to financial products. And the S-curve basically states that you are going to, the company is either gonna develop, innovate, or utilize technologies over time. And these technologies are gonna go through these S-curves. So you're gonna benefit from them. It's gonna be a slow benefit, either productivity gains or distribution gains from these technologies. The benefits are gonna accelerate, and then the technology in the process is gonna degrade over time. Okay, and probably new technologies and processes will be introduced to supplant those technologies. And if they're physical component technologies, they will definitely degrade over time, just because of use. So, you have the time it's introduced, you have the technology itself, and you are going to have, the goal is to have a series of technologies that are actually implemented, utilized, or developed within the process. And if you look at a lot of these financial institutions, there are huge IT shops and computer science components within the corporations. Federal Reserve, all the major banks, broker dealers, hedge funds, they have huge IT operations.
What are the tiers?
This is the time, okay? I'm sorry, I used T for both, but this is the time period, the introduction of the new technologies, and the actual technologies themselves. So you know, we had personal computers, and desktop computers, and we had laptop computers, and now we have tablets, and now we have cell phones. So that could be the technology cycle for the development of those technologies and the major benefits that have not only occurred for the people who use them, but the benefits of the firms that actually developed the technology. So the goal is, if you're a developer or you're utilizing these technologies, is to develop and utilize the technologies in a continuous path over time, which is going to be your revenue growth curve. And the idea is that can you do this over and over again, continuously, consecutively over time to generate revenue growth? Because if you can generate revenue growth or free cash flow growth, that's the ultimate objective for stock price maximization and wealth creation using corporations and technologies. Second model is not an operations research model, it is a marketing model. And it's the product adoption cycle. Do you understand, when you're developing product and process, that it goes through an adoption cycle? And actually the adoption cycle is the revenue growth curve, okay, for these processes and these products. Now, in the first phase, is going to be the innovator phase. Early stage adoption, people who want to be the first to do it, but it's not early majority or majority adoption. And this, depending on the lag here, could basically determine the product failure and the burn rate and the cost overruns. Okay, because people aren't adopting and the product's not scaling. So you have high cost in here. High cost of client acquisition, very expensive. And the adoption is flat. And there's a lot of fixed cost overhead, allocation, and sunk costs. So when we talk about startup companies and startup capital later on in the semester. We'll get into a little bit more of that. The cost of acquisition, these clients, some cost of burn rates could kill you if you don't know what you're doing. And a lot of companies don't know what they're doing. And they're getting bad advice from their advisors. So then, if you're lucky, the product starts to adopt and goes through an exponential growth curve. And if you can do it, and this is where a lot of firms totally fail too, is they can't scale. So you gotta be able to scale, you gotta be able to distribute, you gotta meet the client demand, you gotta utilize the technology effectively, and you gotta be able to distribute the product. And financial products are a little bit easier to distribute because you can distribute along high-speed telecommunications and do a lot of stuff online. You're not delivering a physical product in those cases. So you have very, very high productivity in distribution of these services. So you're going to scale. You're going to get exponential revenue growth. You got to be able to scale. And this phase is called early majority adoption. At this point, has anybody ever heard of unicorns?
Yeah.
Unicorns? Unicorns, what are unicorns?
Like Uber's unicorn, it's earnings.
So you got some cash flow coming in, or maybe, there's no profit, or maybe there's no cash flow. So you could have zero cash flow, you could have negative cash flow, you could have positive cash flow. The expectations are obviously for positive cash flows in the future. So they'll look at this adoption cycle and they'll start to project out the revenue streams. Okay? And then what they'll do is they'll slap on some kind of multiple, kind of X factor, on the cash flows. And this could be 100, 500, 1,000, you back into the valuations. So if you look at the unicorns, their valuations are off the freaking charts. But they haven't generated any profit. They're just scaling, and they might even be having negative earnings in cash flows because they're burning through a lot of their cash. But still, their valuations are really high. So the venture capitalists and others, startup financiers, are looking at these companies, and they're projecting out what the cash flows are going to be in the future based on the trajectory of the adoption cycle in early majority phase. And that becomes the pro forma in which you do the PEs, MPVs, IRRs. The multiple approach is what they use to be able to calculate the values for these early startup companies in early majority. And the question will be, does the founders have the expertise to be able to handle the scaling factor associated with being able to produce the product and distribute it to capture the market? These financial institutions can do it. They have the scale, they have the ability to do it, and then they introduce products over again. So at some point you're going to reach the majority adoption. Basically anybody who's anybody in the marketplace has basically adopted the product. Okay? So at that point you got to figure out, okay, do I keep it? What do we do? Do we sell it off? Do we keep it? Since we already got the market. And then the product will already be adopted by everybody, and then there'll be a trickle of people that come in at the end that will adopt it, and those will be the laggards. And it'll go into decline. Your revenue streams will go, and your revenue growth rates will go into decline. Now the goal of the company, if you can do it correctly, and some companies are really, really good at it, is basically you create a successive series of products, basically a constant stream of product adoption adoption, taking advantage of the Hawthorne effect associated with introducing new products, and then creating, in the end, continuous upward trajectory of your revenue growth. If you can do that, you can grow and your revenue streams on a constant basis, continuously and contiguously over time. You are gonna maximize the share price, which is the ultimate objective for maximizing firm value. But you have to be able to conduct a financial feasibility, because these product developments, these process developments are expensive. You gotta deploy capital, both human and physical, other types of resources, so you gotta be able to underwrite them and figure out which ones are gonna be successful, and not fund the ones that are gonna fail in midstream. So you gotta conduct a financial feasibility. How are we doing on time?
30 minutes.
Okay. So you gotta conduct a financial feasibility. So what are you gonna do? You got R&D, you got sunk costs. You may acquire firms and their technologies, and their distribution, and their clients. But again, it's gonna be sunk costs. You would have to be able to project out what the revenue contribution is gonna be to the firm. You gotta be able to do the cash flow projections based off the technology and the product adoption curves. Then you have to actually calculate present value of the cash flows from the projects and the products. You gotta be able to calculate the net values, which is basically the present values, the cash flows, future cash flows, discounted back, minus the cost, the development cost, the acquisition cost, to see if the net present value is either positive. And if the net present value is positive, you're gonna accept the decision to develop the process of the product. If the net present value is 0, you're gonna also accept the project and the process. If the net present value is negative, you are going to reject it. If the internal rate of return on the cost, the internal rate of return is greater than your cost of capital or your expected return, you are going to accept it. If the internal rate of return is equal to cost of capital or the expected return, you're going to accept it. And if the internal rate of return is less than cost of capital and the expected return, you are going to reject it. Firms are also looking for break-evens. Yes, sir.
What was the other part besides cost of capital?
That's expected return. We need to get a 14% rate of return on all of our products and all of our processes, all of our advertising campaigns, all of our marketing campaigns. We would need a rate of return of 14%. If we can't get 14%, we're not going to do it. Okay, so it's expected return. And those are also called hurdle rates. Companies also use break-even. They put out cost price, how long is it gonna take for me to offset my cost through incoming cash flows? Is it gonna take me 1 year, 2 years, or 3 years to break even? In most cases, 3 years is too long. They may do 2 years, but it's usually less than a year. And some of these tech companies want it in less than a year. Okay, so they have very high metrics that they need to exceed to be able to do the project. And then lastly, it's like, well, the project, has a negative net present value, all right? So what I can do is I can go back and renegotiate the acquisition price, review the development cost, the costs associated with the campaigns, or whatever the costs or acquisition costs are. And if I can lower the costs by the amount of the negative net present value in dollar terms, the net present value is gonna turn to 0, and I'm gonna accept the project. I'm getting a negative net present value of negative. Maybe I can't reduce the cost. I can go back and review the assumptions that I put into the model. Still, I may be able to accept it or reject it. Maybe I have to reject it again. I really want to do this product. I really want to do this process. I really want to introduce the series of products, financial products, because I know deep down in my guts that it's going to be a success. Well, what we'll need to do is to calculate a real call option. We'll go through that. And basically that's going to be due to the revenue possibilities, the amount of time it's going to take to develop that product, but I can figure out another method for the investment analysis process. I'll go through this a little later. But if the value of this real call option is basically in the amount is greater than or equal to the negative net present value, then I'm going to accept the project because the NPV is going to turn to 0. So there's another method of calculating the success of a project outside of the traditional methodologies that you're learning in the class. This is used a lot in biotech. It's used a little in finance. It's used a lot in real estate. It's just another methodology that's been introduced because there may be information that's not being captured in this traditional method that the option model will capture. Okay, and I can talk a little bit more about that later. So the last piece of success is going to be, do you have entrance and exit strategies to get into and out of markets? Or are you going into markets and out of markets based on gut feel, which is pretty shocking because there was a survey done on venture capitalists and how they make decisions on firms, and how to spin them off and how to acquire, and like 50% of people make decisions based on gut feel. They do not use quantitative methods, unbiased methods, which means that probably they have pretty high failure rates in their acquisitions. It's just the profitability of the ones that are successful make up for the exorbitant amount of losses associated with their their myopic process. So market entrance and market exit. And also you have to be able to, you gotta be able to execute. You have the plan, the resources, the people, the personnel, the technology, the processes in place to be able to enter and exit the market efficiently and get in and get out. So you gotta be able to put together rules-based systems and metrics that basically state the product or process has met the criteria. We either keep it, or we spin it off as another company, or we sell it to another person. And we do a capital event. We do a capital event. And knowing how to do that and execute on that is huge. Because if we did it right, we're gonna make a lot of money, we're gonna distribute it to the investors and the shareholders and the employees who basically executed on the plan. It has to be unemotional. I do not want to sell off that company. I do not want to discontinue the product because I was a founder in that, and I want to keep it because it's my baby. Okay? So it's got to be unemotional. When you have emotion involved in the process, you'll probably make mistakes. You'll be blind to the reality of the situation. No gut feel. Maybe we should put together some metrics to be able to make our entrance and our exit decisions for us. We all come to an agreement, and then it's a rules-based approach to get in and out. Okay? And you will probably not make the mistakes. Then you're going to decide, are we going to divest? Are we going to spin off? Are we going to do an initial public offering, either sell it to a private acquirer, or do we take the division and its product lines and make another publicly traded company out of it, and basically keep the shares as basically part of the company's wealth, and then liquidate the shares in the future and redistribute the rewards to the shareholders that invested with us and the employees that were part of the overall process. Go ahead.
When you say capital event, do you mean raising capital?
The capital event is going to be when you decide to spin off, go IPO,
Okay.
sell off the company. That's the capital event, because you put out a lot of money to basically build this thing, this product line, these services, these technologies.
Right.
But you got to have a capital event at some point.
Right.
You could be generating and internalizing the cash flows, but at some point in time, the cash flows, growth rates are going to degrade, and you have to pick the time in which you can either keep it, because it's basically around its life cycle, so why not sell it off or spin it off into the marketplace?
Okay.
Okay? And a lot of companies will do that, and a lot of the employees will go into these spin-offs.
Okay.
And a lot of the employees will spin off, they'll go create product and process, and then they'll have relationships with the parent company, and they will buy out their company at some point in time. And that'll be a capital event for the founders. Okay? How much time do I have?
20 minutes.
20? I might be over time. What I want to do is shift gears now and talk about modern portfolio theory. Okay? And again, you could be building portfolios of bonds, portfolios of stocks, portfolios of real estate, portfolio of products, divisional lines, product lines, within the organization. The key is, do you understand how to build portfolios, to generate those expected returns, and to diversify the revenue streams, so that the revenue streams are not correlated to each other. So if one of the divisional lines, or one of the stocks, or one of the bonds go insolvent, or default, or go bankrupt, it doesn't take down the whole portfolio. So you got to be selective in the construction of these portfolios. And the theory is called modern portfolio theory. Or MPT. And the theory was developed by Henry Markowitz in the 1950s. He basically wrote the book and built the algorithms to be able to run and calculate the covariances and correlations between the returns on the stock portfolios, bonds, real estate. But it was mostly a stock model. But just imagine you have 100 stocks within your portfolio, and you got to run the correlations and the covariances amongst the combinations. You're basically looking at a factorial. So the processing and the storage of that data is extremely intensive. And it wasn't until the introduction of the personal computer and the mini computer that had the technology to be able to run those calculations. And it basically created the mutual fund industry in the 80s and the exchange traded fund industry in the 2000 period. So the technology allowed for the product development to actually occur. And most of those products right now, both those products are now fully adopted at the institutional and retail level. The portfolio theory basically states that you have expected return on the y-axis, and you have the standard deviation of the portfolio on the x-axis, which you know how to calculate now from the pre-test. Coming out from the y-axis is what is called the capital allocation line. And it starts at the risk-free rate. The first line, the most important, is called the efficient frontier umbrella. And basically the efficient frontier states that I can build portfolios of stocks, bonds, real estate, or a combination thereof by using assets available in the capital markets to be able to construct the portfolios. So these are basically feasible portfolios that can actually be constructed using assets that are actually available in the marketplace. I can create a 100% stock portfolio, and yes, it's going to be a high risk, but it's also going to give me high expected return. I can also construct a portfolio of 100% bonds. Yes, I'm going to get a lower return. I'm also going to get lower risk. If I want to, I'm willing to take on more risk because I want more return. So I could sell off portions of my bond portfolio and buy stock and increase the rate of return on my portfolio, but also increase the risk. I can also, if I'm willing to reduce the risk of my portfolio and I'm willing to take lower risk, then I could sell off my bonds in my portfolio, or sorry, sell off my stocks in my portfolio, buy bonds. I'm going to reduce the risk of the portfolio. I'm also going to reduce the return within the portfolio. So at some point, I'm going to get to a tangency point between the capital allocation line and the efficient frontier. At that tangency point, that is what is called the market basket. So it's basically the combination between stocks and bonds. And what you do is you look at the value of stocks in the market, the value of bonds in the market, add them together, divide them back to get the percentages. So historically, in a two-asset portfolio of stocks and bonds, you would have 30% of your allocation to stocks, and you would have 70% of your allocation to bonds. Bonds, you can deduct the interest on the interest payments on the bonds, and bonds have first claim on the cash flows over the equity holders. So because of those two attributes, more corporations issue more bonds over stocks. And it's cheaper to issue bonds over stocks, too, so there's an incentive to use bonds over stock. Most investors want to get a high rate of return at very low risk. But the problem is there's no tools, there's no investments that provide high rates of return at very low risk. So the investors have to reduce their utility to basically get to the market and get to a portfolio that will give them a high risk adjusted rate of return. So they have to reduce their utility. And what they'll do is they'll arrive at the market basket. So where the capital allocation line, the efficient frontier, and the utility curve all intersect, that is the market basket. And at that point, you are going to be receiving the highest expected return on the portfolio at the given level of risk. At that point, your expected return on the portfolio divided by the standard deviation of the portfolio is going to maximize the risk-adjusted return. Now, this is the requirement for institutional investors and risk-averse investors. This is the bulk of the capital markets, the investable market. The institutions and individuals who have money high risk adjusted rates of return. Not high returns, but high risk adjusted rates of return. And in most cases, these investors want 8% to 10% rate of return. Because under the rule of 72, which is in your book, is you will be able to double your money in less than 10 years. So if I can get my clients 8 to 10% rate of return on their portfolios, their money will double in less than 10 years. That's all they want. So the expected return is basically a constant. So really the focus on the portfolio as a portfolio manager is to basically construct a portfolio whose asset returns have low, no, or negative correlation amongst each other. So by reducing the portfolio standard deviation, you are going to increase the risk-adjusted rate of return, and the money will flow into the products, and will flow into the portfolios. So the target, oh no, there's one more piece here. So the key is portfolio diversification. And products like annuities, these guaranteed products, and cash value. How am I doing on time?
10 minutes.
Okay, I got it. Can do it. So cash value life insurance, private equity real estate, I would even say guaranteed, annuities, alternative, renewable energy. These are called alts or alternatives. These alternative returns, the returns on these alternatives have no, low, or negative correlations with the returns on stocks and bonds. So what happens is because of the low, no, and negative correlations in the returns between stocks and bonds, it actually bows out. It bows out the efficient frontier. Yes, your expected return on the portfolio is going to drop, but the reduction in the portfolio standard deviation is going to be well more than the reduction in the return. So if you can significantly reduce the portfolio standard deviation through investments in the alternatives, you are going to maximize and increase the risk-adjusted rates of return, which is bulk of the capital in the capital markets for institutional investors and retirees and other people who are scared of risk. So the target, in my view, the target or the model portfolio for the next 30 years for investors is going to be 40% bonds, it's going to be 30% stock, is going to be 10% cash value life insurance, going to be 10% private equity real estate, and 10% alternative renewable investments. Now, Ibbotson and Associates is a well-known firm that conducts these portfolio analytics, did the research, and came up with the 10% allocation. Ibbotson and Associates in the 80s did the portfolio analytics, came up with a 10% allocation to private equity real estate. And Deutsche Bank Reef, which is their alternatives unit, did the portfolio analytics and came up with a 10% allocation to renewable energy products. All in the private market. So you're locking in your rate of return, reducing the volatility in the returns, providing guarantees, bowing out the efficient frontier, and yes, reducing the return, but significantly reducing the risk within the portfolio. That's the name of the game.